Welcome to the Depth Dive. Today we are taking a deep breath and plunging into the 2018 shareholder letter from Fairfax Financial Holdings Limited.
Yeah.
For anyone focused on, risk management, capital allocation, and maybe the gritty details of value investing, this document it's gold.
Oh, it really is. Because 2018, well, it was a stress test unlike almost any other. You had massive market instability.
Right, especially late in the year.
Exactly, particularly that sharp drop in Q4. And then at the same time, the insurance industry was facing these huge catastrophe losses.
Yeah.
What was it, $90 billion globally?
A staggering number. So here's our mission, really. How does a major value-oriented holding company, one led by a famously patient investor, how do they navigate this specific kind of turbulence? And we start with, I think, the central paradox. It's right there in the source. This company, since 1985, has compounded book value at an unbelievable 18.7% annually. Just incredible.
It really is.
Yet, in 2018, the year we're looking at, the book value actually decreased by 1.5%.
And that 1.5% decrease, that stall, let's call it,
Right.
that's really the core tension we need to unpack here.
Right.
Because despite that setback, the company still managed to generate, $376 million in net income.
Which tells you there are two completely different stories unfolding under the hood, right?
Absolutely. One is about, brilliant operations on the insurance side,
Okay.
and the other is about the brutal market environment just hammering their investments.
Okay, so let's start with the engine room then, the insurance business. The letter puts it very plainly. Ours is a risk business.
Yep. And you mentioned the $90 billion industry loss in 2018. That followed $130 billion in 2017.
Wow.
So together, those were two of the worst years historically for natural disaster claims, just back to back.
And Fairfax felt that directly. Their own cat losses hit $752 million.
Yeah, and this wasn't some theoretical number. These were realized losses from specific massive events. We're talking $233 million gone from the California wildfires.
Yeah.
Another $138 million from Hurricane Michael. $102 million from Typhoon Jebi in Japan. I mean, the core business was under extreme pressure.
Given that kind of external hit, you'd almost expect their insurance profitability to just evaporate.
You would, yeah.
But it didn't. Their consolidated combined ratio, which for you listening is just the measure of expenses and claims versus the premiums they took in, it was an outstanding 97.3%.
That is the critical metric. Anything under 100% means they're actually making a profit on the underwriting itself.
Before investments.
Before investments, exactly. Even after paying out nearly $750 million in these catastrophe losses, it's a powerful demonstration of resilience.
And within the group, you got to call out the stars, right? Zenith.
Oh, yeah. Zenith was phenomenal. An 82.6% combined ratio. Exceptional.
Incredible.
And Odyssey Group also did really well, 93.4%. So, yeah, they're managing the actual insurance risk incredibly well.
Which brings us neatly to the magic of float.
Ah, yes. Float.
Float, for you, the listener, is basically the money an insurance company gets to hold on to. It's the premiums collected before they have to pay out claims. Essentially, a pool of money they can invest.
And here's the kicker. Since they started 33 years ago at that point, Fairfax has maintained a cumulative combined ratio of roughly 100%.
And why is that 100% number so important? What does that actually mean?
It means they've generated about $20 billion of that float capital over 3 decades.
Yeah.
At essentially zero cost.
Zero cost.
In fact, in 2018, the cost of float was actually a benefit of 1.6%. They made money on the underwriting.
Wow.
Over the last decade leading up to 2018, it averaged a 0.7% annual benefit. Put that in context.
Yeah.
They're essentially getting capital cheaper than governments. The Canadian government's 10-year bond cost was 2.7% over that same period.
That's amazing.
And their float per share had grown massively too, reached $826. They're literally being paid, on average, to hold and invest billions of dollars.
Okay, so we've established the operational engine. The insurance side is solid, very solid.
Yep.
The float is secure, it's even growing, and they absorbed these massive cat losses while staying profitable on underwriting.
Right.
Now let's look at the other side of the coin. The cargo, maybe? The investment portfolio?
All right.
Because that's where the trouble hit and where that 1.5% book value stall came from.
Precisely. They were aiming for a 7% return on their, roughly $39 billion investment portfolio. That's what they needed to hit their overall equity return target, assuming insurance broke even or slightly better.
Okay, 7% target.
They only achieved 3.1%.
Ouch, that's a big gap.
It is. And that underperformance is really the hinge of the whole story for 2018.
So how could a company that's so disciplined, clearly, on the insurance side, How could they miss their investment target by more than half? Was it a bad strategy or just, like you said, that perfect storm?
It was overwhelmingly the storm, but maybe amplified a bit by their accounting.
How so?
Well, the returns cratered because of that fourth quarter collapse in stock prices. And
Right.
here's the maybe slightly technical but really key point. They use mark-to-market accounting.
Okay, explain that. Mark to market. What does that actually mean for you, the listener, watching their results?
It just means paper losses or gains hit the income statement immediately.
Hmm.
So if a stock they own plummets on December 31st, even if they haven't sold a single share,
The loss gets booked right then.
right then and there, it makes the reported returns really volatile, especially in panic periods like Q4 2018.
Got it.
So that Q4 panic meant the net gains on their stocks, their equity exposure, contributed only 1.0% to that total 3.1% return for the year.
So barely anything from stocks.
Pretty much. If it weren't for the steady income from interest and dividends, that was $784 million, or 2.0%, the overall investment picture would have looked much, much worse.
And the market volatility was just brutal. You can see it reflected in some of their specific holdings listed in the letter. Fairfax Africa down 42.7%,
Ooh.
Quest Corp down 42.8%, BlackBerry down 36.3%. I mean, those are huge drops.
Massive drop. And they really highlight the kind of short-term pain you have to endure if you're sticking to a long-term value approach in that kind of market.
Which leads us right into their investment philosophy, doesn't it?
It does. The chairman, Prem Watsa, he really lamented that deep value stocks,
Yeah.
the kind they like, have underperformed growth stocks in almost every year for the last decade, except for 2016.
And when they say growth stocks, we're basically talking about the big tech names driving the market then, right? The FAANGs.
Exactly. Facebook, Apple, Amazon, Netflix, Google.
Yeah.
Them, plus the rise of ETFs and index funds generally,
Mm-hmm.
that whole structure dominated.
Okay.
And their thesis, Fairfax's thesis, is that this kind of passive index-driven market, it actually creates massive opportunities down the road for active stock pickers.
Why? How does that work?
Well, the thinking is, if everyone's just buying the index, then really good companies that aren't in the index, or maybe they're just temporarily out of favor,
They get ignored.
they get ignored. Or worse, they get severely mispriced, way cheaper than they should be.
So they're basically calling the end of that trend. They're forecasting that the market structure itself, where maybe indices don't do so well for the next 5 years, is about to flip.
That's the bet, swinging the pendulum back to a stock picker's market where their deep value style will finally, outperform again.
That's a huge bet on market cycles turning.
It is a massive bet. And you really see the conviction behind it when you dig into some of the specific portfolio highlights they mention. They're betting on these deep, often complex turnaround situations.
Okay, let's look at some of those. Let's start with one you mentioned that saw a big drop, BlackBerry. Stock price fell hard that year.
Yeah, down 36%.
But the letter talks about this strategic pivot under CEO John Chen that Fairfax is heavily backing.
Right. And that pivot is, away from the old handsets and really deep into sophisticated software. They highlight the big $1.4 billion acquisition of Cylance.
Which is AI cybersecurity.
Exactly. Focused on artificial intelligence and cybersecurity. The plan seems to be combining BlackBerry's existing mobile security chops with Cylance's AI. The goal, they state, is to potentially become the world's largest AI cybersecurity company.
Wow. Ambitious.
Very. And then you also have QNX, which is still a major leader in operating systems for, like, autonomous cars and connected vehicles.
So for Fairfax, the stock drop in 18 is just noise if the underlying strategy works out over, say, 5 or 10 years.
That's the philosophy. Ignore the noise, focus on the long-term value creation.
Okay, moving to their global banks. You see some incredibly bold moves, especially in places that look pretty risky from the outside. Take Eurobank in Greece.
Yeah, Greece. Not exactly the safest bet in 2018.
Right. But the CEO there had this bold plan, dividend out something like $7 billion of non-performing loans. It basically toxic debt.
Which is risky in itself.
Highly risky. And then merge the cleaned up bank with Gravalia Properties.
Right. The goal being, if they pull it off, Eurobank becomes the best capitalized bank in Greece, perfectly positioned if or when the Greek economy really turns around.
Yeah, it's a super high conviction bet, concentrated, focused on a macro recovery.
Definitely. And then you contrast that with, say, CIB in Egypt, a commercial international bank.
Which they praise as one of the world's best banks, right? Like 25% plus return on equity for decades.
Operationally fantastic.
Right.
But It's the perfect, almost textbook example of how currency risk can just crush your returns, even with operational excellence.
How so?
Well, the stock price itself in Egyptian pounds was up something like 220% since they first bought in back in 2014. Great performance.
Sounds amazing.
But the Egyptian pound got devalued massively in 2016. So when you translate that 220% gain back into US dollars, which is what matters for Fairfax's reporting,
It shrinks.
it shrank to only a 30% gain.
Wow.
It just shows, in emerging markets, you can pick the best company, you can perform brilliantly,
Yeah.
but if the currency collapses, your dollar returns can get hammered.
Okay, switching gears a bit, real assets. Their partnership with Kennedy Wilson, the real estate firm, that seems like a huge success story.
Oh, absolutely. A blockbuster. Since 2010, they'd put in about $855 million. By the end of 2018, they'd already gotten back $858 million in cash.
So all their initial capital back already.
Plus a bit more. And the kicker, they still held $351 million worth of real estate from that partnership.
That's incredible performance.
It works out to an average annual realized return of 21%. Just phenomenal capital allocation. And it really shows their model, right? Use that low-cost float from insurance.
Yeah.
Find excellent partners in other areas, deploy patient capital, wait, and then realize these huge gains.
And speaking of huge potential, let's talk India. They clearly see India as a cornerstone for future growth, specifically the Bangalore International Airport, BIAL.
Yeah, BIAL. At the time, it was the third largest airport in India, but get this. It was the second fastest growing airport globally.
Wow.
Serving 32 million passengers that year, which was up almost 30% from 2017 alone. Just explosive growth.
And they're not just dipping a toe in, they're planning a massive $2 billion expansion.
$2 billion. Second runway, second terminal, and crucially, they say it's being internally funded.
That's a monster bet on Indian air travel and economic growth.
It absolutely is. And finally, just to round out the portfolio picture, they also show they can successfully exit when private assets mature. Look at Arbor Memorial.
The Canadian Funeral Home Company.
Well, that's the one. They sold their stake for CDN $152 a share. They bought it back in 2012 for CDN $32.
Nice return.
Works out to a 34% annual return over about 6 years. So it shows they balance that long-term patience with knowing when to actually cash in.
Okay, this brings us to our next section, risk management evolution. And there's a really candid admission in this letter, isn't there, about shorting stocks and indices?
Yeah, this is where you really see the humility, I think. And the admission is pretty stark. They state they had cumulatively lost about $2 billion.
Million, with a B.
$2 billion
Yeah.
from short positions betting against indices and specific stocks since roughly 2008.
$2 billion. That's a huge drag on shareholder value over a decade. Why stick with it for so long?
Well, they didn't really explain the why so long, but they did acknowledge the failure quite directly. And the action was clear. They decided to discontinue shorting entirely.
Okay, just stop.
Just stop. The rationale given was pretty simple. Shorting's inherently short-term. You're fighting the long-term upward bias of markets. And crucially, it has uncapped loss potential. You can lose way more than you initially bet.
Right, infinite risk, theoretically.
Exactly. So the new approach, if they want to hedge, they'll use options, which limits the downside. You know exactly the maximum you can lose, a potential finite loss, as they put it.
So, an expensive lesson, but learned.
Very expensive but learned. And I agree with you. I love the way it's phrased in the letter. The chairman admits he is learning slowly, with 2 exclamation points.
Yeah.
That single line tells you so much about the culture, right? They're willing to admit a massive $2 billion mistake, learn from it, and actually change the strategy. That's rare.
It really is. And that learning culture, they call it the Fairfax way. It seems to emphasize being decentralized, fair, friendly.
Right. And they gave an example of that internal collaboration when they had to close the Advent Syndicate at Lloyd's.
Oh, yeah. What happened there?
Well, instead of just mass layoffs and abandoning the business, the leaders from 3 other Fairfax-owned syndicates, plus their runoff company Riverstone, apparently came together.
Okay.
And they figured out a way to offer jobs to almost all Advent's people and actually retain a lot of the insurance business within the Fairfax group.
Huh. So even when shutting something down, they tried to do it in a way that protected the people and the relationship.
Exactly. It showed that even during tough strategic calls, they prioritized their people and, frankly, their long-term reputation, It's all connected.
And that ties right into their future focus, doesn't it?
Oh, yeah.
It's all about that long-term culture, buying back their own stock when they think it's cheap,
Right. Signaling confidence.
and continually doubling down on these high potential, sometimes complex investment areas like India and Greece.
Yep. Stick to the plan.
Okay, so let's try and bring this all together for you, the listener. What's the essential lesson from Fairfax's 2018? For me, it feels like it was about enduring these massive external shocks
Right. The catastrophes, the market plunge.
while keeping the core insurance engine intact, protecting that precious float,
Mm-hmm.
and just rigorously sticking to a long-term value-based investment strategy, even when it was deeply, deeply out of favor.
I think that's exactly right. Their success ultimately relies on a kind of institutional discipline. It allows them to shrug off a 1.5% book value dip as just noise, especially after decades of 18% compounding.
Yeah, perspective.
It's all about perspective. Those long-term returns, they depend on patience, on not getting spooked by the daily headlines, or in their case, the mark-to-market accounting volatility.
So to leave you with a final thought,
Right.
the letter itself provided this really potent analogy. I thought it summed up their whole philosophy perfectly.
Oh yeah, the weather one.
The weather one, they wrote. Most participants in the market are focused on forecasting the daily weather patterns, whereas we like focusing on the seasons.
It's a great line, and it connects directly back to their prediction, right? That the indices might not do well over the next 5 years or so,
Implying the season is changing.
implying the season is changing, potentially back to a stock picker's market. So the provocative thought for you, whether you're an investor or managing a business, is this. If the market seasons are truly about to change, are you prepared? Are you set up to stop focusing on the daily weather, the noise, the short-term swings, and actually wait patiently for that seasonal shift? Because of that patience, that ability to focus on the long game, that seems to be what ultimately distinguishes the true long-term value creators.